I've never done an interview like this.
Like sitting next to them?
Yeah, because I'm like looking at you here and not here.
So, Ben from Into the Cryptoverse, thanks for jumping into the Explain Yourself podcast.
Thanks for having me, Dana.
By the way, thank you for updating your office and everything for this. You really didn't have to go through all of that. I've known you for like 5 years now.
Hey everyone, and thanks for jumping back into the Cryptoverse. Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to provide a tour of Into the Cryptoverse Premium. Hey everyone, and thanks for jumping back into the Macroverse.
Why did you end up starting the Into the Cryptoverse channel?
Because back in prior market cycles, I got wrecked a lot. And I also watched a lot of my altcoins bleed back to Bitcoin. And so I thought in 2019, the Fed was shifting monetary policy. So I sort of thought that we were going to go into a few years where Bitcoin dominance was going to go down. And I thought a lot of money could be made. So I was like, all right, well, we'll talk about this for a couple of years. But I was always very adamant that at one day we would enter market conditions where that would all change. And it would be time to put on our Bitcoin maxi hats and basically just, get on the Bitcoin dominance train and watch that go up and watch Bitcoin take back a lot of market share. So eventually I pivoted my views. But the whole point was just to kind of help people figure out some of the mistakes I made without actually having to go through the pain of figuring it out for themselves, right? Unfortunately, a lot of people have to figure it out for themselves for it to actually mean anything. But the goal was to help people not make the same mistakes that I had made in prior cycles.
You told me then you're at National Labs working, and you were showing me yesterday that you had one screen on the left where you were doing all of your work, and then one screen on the right where you were charting all of the charts.
Right.
Is that right?
Yeah, I was doing both and burning the candle on both ends, I guess. And I got to the point where crypto was growing so quickly that I had to pick one or the other, right? So I ended up picking crypto because it's just growing a lot more. There's a lot more potential there. No one gets a Ph.D. to make a lot of money, frankly speaking. And the sort of the acronyms, as a lot of people in academia say them, is like PhD means piled high and deep, and MBA is massive bank account, right? Is kind of what people say. So like you don't do a PhD to make to you're not really doing it for the money. You're doing it because a lot of times you're doing it because you like research, you like the science, and you want to improve the world in some way. And so when I started the channel, like I didn't think about monetizing it or anything like that at first. I just was like, oh, this is cool, and let me share some cool stuff with people. So I started using a lot of tools that I'd used in college to create cool charts that people could look at, and I just shared them. And then at one point they took off, right? At first I didn't think anyone would really care, and then as time went on, it turned out a lot of people cared.
You had this like conflict of interest. You weren't allowed to do anything that was research based, or you weren't allowed to do anything technical.
I wasn't technically allowed to do anything technical. I went to my manager and I was like, well, look, I'm doing this, and because you have to tell them what you're doing. You can't do two different things without sort of disclosing it. And this was like really when I first started, and it wasn't even, I wasn't even monetizing it at the time. It was just like a fun hobby, but I wanted to. I was like, all right, maybe this makes sense. And they just laughed and said that's not technical. So basically, my research in my postdoc was high energy density physics and like equation of state models in high energy density physics. And so they basically just don't want you doing anything related to what you're actually doing. And so, to go from high energy density physics and molecular dynamic simulations of high energy particles and stuff to then saying, hey, this is dubious speculation in crypto, it's not really something that is viewed in sort of a technical way, I think, in a lot of academic circles. So it was a big jump. It was a big jump for me. And it was, I left that meeting kind of feeling really happy that I could keep doing it, but also feeling kind of somewhat depressed that that's how they view that stuff. But, it is what it is.
How did you explain what you were doing?
So I spent, a lot of my life getting the job that I had, right? I mean, I undergrad mathematics. I was only 2 classes away from a physics major as well, so it was a physics minor. But then, I spent 5 years in grad school, and I did my dissertation was on molecular dynamic simulations of ceramics and in situ transmission electron microscopy of radiation damage in those ceramics. So we would compare the experimental stuff to the computational stuff. So that's basically what I did, and I did the postdoc for 2 years, and then I got converted to a senior, like a senior member of the staff, and I tried explaining it to my boss, and he didn't understand. Like, he didn't understand like why I would throw all that away, for to go, I guess, dubiously speculate, right? I mean, that was the kind of the idea, but I ended up talking to other people that I like respected, and talked to my wife's dad and her brother, and it was kind of hard being like, hey, I know, I did this postdoc and I did all this stuff, but I'm just gonna throw it all away and go to this other thing. They're actually really supportive of me quitting that life and then doing this stuff full time. But when I did finally quit, it was really hard. I remember just like standing at my desk. I cleaned off my desk. I went to like the door. I just stood there and I looked at my desk for probably like several minutes, because that was the last time, right? That was the last time I was gonna, be in that building. And I turned the lights off and walked out, and that was that. But it was really hard because, I mean, life throws you curveballs, and you just have to run with it sometimes, even if it doesn't make sense to you or wasn't part of your plan, I guess. So this wasn't really part of my plan, but it sort of just fell into my lap.
For context, this is what you were doing before. So all you guys arguing online, these are the important things that Ben was doing before he started talking to degens online. I don't know what this is. So I was an econ major. I have no idea what this is.
When I did stuff, I was always working with like extremely large data sets. Like oftentimes, like every simulation I was running was like hundreds of gigabytes of data that was spitting out, sometimes terabytes of data. And so I got really good at analyzing really large amounts of data. And so you could argue crypto is a similar thing. It's just, the data is somewhat different. But I think if you can get really good at analyzing data in one field, you can transfer that to another field. In fact, a lot of people on Wall Street actually are Ph.D. scientists and engineers, because it's all about applying the same types of algorithms and stuff to the stock market and to, just to Wall Street. Basically, what happened was one of the ways I was able to sort of justify making the transition to the new career was when I was working on the high energy density physics stuff. It was great, right? I felt like I was making a difference, but the downside was it wasn't something most people cared about or understood or even knew was a thing, right? Only a few people in the world like even knew what I was doing or really cared about it. That didn't mean it didn't have value. It just wasn't obvious to most people like what that value was, right? You can say, oh, I work at the national lab, but when you actually try to explain like exactly what you do and how it's beneficial to society, it's not always obvious. When I decided to launch this, I'm like, oh wow, like it has a much more tangible effect. Like if what I say on average, more times than not, if what I say is correct, then it could have a good outcome for people, right? And so I noticed that it was having a more tangible effect, and people were like appreciative of it back then in like 2019, 2020, and so I think because of that, because I knew I could reach more people that way, I was like, oh, well, maybe this could be a way that I spend my time, and it would be more impactful on society if I do this over this other thing. Now, again, I don't know at the end of the day if that's actually going to be true or not, but that was the justification at the time for one of the justifications at the time for sort of making that move over, was just to have a bigger impact. Because actually, when I was at the labs, one of my main struggles was, toiling away on these really niche things that most people don't care about, right? A lot of people care about markets and investing and money and how you set yourself up for the future and stuff. Like a lot of people care about that. So it seemed a little bit more obvious how I could have a larger impact.
I want to look at the ITC website.
These are the risk metrics. So we have risk metrics for Bitcoin, a lot of different cryptocurrencies. Basically, the idea is that it just goes between 0 and 1. And so the blue dots are really low risk, and then the red dots are really high risk. And what you'll notice, if I can, maybe I'll make this a little bit smaller so we can actually see what's going on up there. But yeah, what you'll notice is that there's sort of like a method to the madness, if you will, right? Like it seems, sometimes the markets seem extremely volatile, and they are, but there's also a way to quantify that volatility. And so basically the idea, I created this risk metric back in 2019. So it was like right here where I created this risk metric. And basically the idea was, all right, guys, no one knows what's going to happen, right? A lot of people online pretend to know what's going to happen in the markets, but the reality is no one has a crystal ball. And so the best thing to do is just manage your risk. And that's the way you ultimately become a successful investor, is not making sort of outlandish predictions and not calling for alt season every week, but just saying, you know what, given the risk profile I want to take on, this is what I want in my portfolio, and this is the risk I'm going to take. And so it can be kind of hard to decipher this. And so what I really like to do is I like to look at it like this, where we take the color out of it, and you're just looking at the risk. And basically what you'll notice is that, you know, any time that the risk metric goes below 0.2, it's time to load up. And then anytime it goes up to the higher risk bands, right, it's generally time to slowly sell. And the way that I do this, though, is I don't just sell everything at you know, the highest risk band and then buy everything at the lowest risk band. I do something called like dynamic DCA, right, where, you know, the lower it goes, the more I buy. And if it goes, say, above 0.6 risk, then I will sell some of my portfolio, but not a lot, just like a small amount. In this case, it could be like 1/10, you know, 2/10. It could be whatever you want. But the reason is you want to take some profits in case you get a repeat of 2019, right? Where it, you know, you don't really go all the way up, and then you get like a drop in between that move. But you also don't want to sell everything, because, well, what happens if you sell everything and the market just screams higher for a year? So it basically allows you to have a plan no matter what happens. And I think the cryptoverse can have sort of adverse effects on a lot of people if they spend too much time looking at the screens and trying to figure out what's going to happen. But I think it's better just to have a plan no matter what, and say, you know what, if it goes up a lot in a short period of time, I'm going to sell into that. And if it goes down a lot in a short period of time, I'm going to buy into that. And it can be easy to let your emotions rule that. And so I just try to quantify it. And so I use this risk metric. So when the risk is low, I tend to buy. When the risk is high, I tend to sell. There's other charts that I use as well. And maybe one of the charts is this one. This is just the total market cap of the entire cryptoverse. And this red line is more or less like a fit to that data. So that red line at any given point arguably tells you what the quote unquote fair value is of the asset class. And the fair value in this case is a monotonically increasing function, not because I decided that it was, but the chart decided that it was, right? I mean, over time, the valuation of the cryptoverse has gone higher. Now, it could be due to a number of factors. Maybe it's just because they print more money. Maybe it's because there's value in the cryptoverse. Probably a combination of both. But generally speaking, you know, when you're below the red line, Bitcoin is taking more market share. When you're above the red line, a lot of times Bitcoin is taking less market share, and that's where oftentimes you get the coveted alt season that people really want to happen. So this is one of my favorite charts, and I come back to this one a lot. And one of the things I like to do is just take the percent difference between the total market cap and the fair value logarithmic regression trend line. And if you do that, you just get this chart right here. And so it shows you when the asset class is below the red line, you could argue that it's undervalued. When it's above the red line, you could argue that it's overvalued. And so you can see that we just, you know, there's been a couple of times this cycle where the asset class went slightly overvalued, but it didn't durably go overvalued like it did in prior cycles. At least it hasn't yet. Now, of course, it could be due to the macro side of things, could be due to monetary policy, right? It could be due to a number of things, but this is one of my favorite charts to look at as well. And I do a video on those two charts every month called Bitcoin, the Beauty of Mathematics. Some of the other favorite charts are Bitcoin dominance. I guess I've especially become known for this one, talking about this one a lot this cycle. And I do often like to exclude stablecoins, because stablecoins make up a big component of it. And so if you exclude stablecoins, the chart really is a lot different. It shows you, that the merge, when we had the merge for Ethereum, dominance did not put in a lower low. If you include stablecoins, dominance did put in a lower low. But I don't really care what the market cap of Bitcoin is doing relative to the stablecoin market cap. I'm more so interested in what is it doing relative to the altcoin market cap. The reason for that is because of opportunity cost, right? For every dollar I have in Ethereum or Solana or Cardano or Polkadot or Avalanche or whatever it is, right? For every dollar in those, that's a dollar not in Bitcoin. And I value my portfolio in Satoshis. I think in terms of sats, right? Like if I go buy something that's expensive, I think in terms of Satoshis. For instance, I got a new computer recently, and I instantly started thinking, oh, well, this is how much Bitcoin is this equivalent to? Not that I was selling my Bitcoin to buy it, but just like, oh, well, that money has an opportunity cost associated with it, and so that's why I think it makes sense to focus on things like Bitcoin dominance. So this is another one of my favorite charts that I look at, and there's a few others as well. I do tend to come to like the running ROI of Bitcoin, just kind of see like where is it compared to prior cycles. Some of the favorite charts that I have are the cycle ROI charts, right? So if you scroll down, looking at things like the ROI of Bitcoin as measured from the cycle bottom, and just looking at sort of the last few cycles, you can also measure it, say ROI peak to peak, and look to see how Bitcoin is performing like that. A lot of times I'll ignore the first cycle because it was all the way back in like 2010, and the market cap was really, really low back then. But you can see that really ever since then, a lot of the cycles, it always feels like they're different, right? It feels like they're different. But then you look at the chart and you're like, well, it actually looks the same. I think this cycle feels different for a lot of people because of a chart that I've actually become a lot more fond of. There's something called the Advanced Decline Index, and it's mostly talked about in the equityverse, right? It's sort of the equity side of things. But we created it for cryptocurrencies. And essentially what it is it allows you to know if the market is trending up because the entire market is trending up. So you have like the breadth of the market. So it's not just Bitcoin, it's the altcoins too. Or if the market is trending up just because Bitcoin is. So the orange line, in 2018, in January 2018, started to drop. And it did not bottom until about 2 years later. So a lot of people, and this is around the time that I launched my YouTube channel, was in the summer of 2019. So I saw this change in monetary policy coming. I figured that this trend was going to change soon, and it did. The problem that has happened this cycle, and I think caught a lot of people off guard, is that this ADI has been trending down since January or since November of 2021, right? So just like over here, it trended down. This cycle, it's trended down a lot longer. And I think that explains why people feel so bad this cycle, because, if you sort of underestimated something like Bitcoin dominance and overestimated, the valuation of altcoins, especially on their Bitcoin pairs, then there could have been some misallocation of capital. Now, this trend will likely change at some point, but it's important to remember that these trends can go on far longer than a lot of people expect, and it really shows you like why alt season hasn't happened, right? You can sort of visualize on the chart, hey, the market was going up, but even though the market was going up, the ADI, the top 100 cryptocurrencies, was actually trending down. So it kind of explains sentiment, and maybe just a couple more charts just to sort of finalize. We also track like a lot of on-chain charts, which I think that there's a lot of value in those. We have like the HODL waves or HODL waves, how you want to call it, where you can basically track, long-term holders or short-term holders, right? You can track long-term holders and see what they're doing. A lot of times long-term holders will sell into parabolic rallies, and that's where these charts sort of dip off. And so you always want to be aware when long-term holders are selling. And you can see that long-term holders were taking profits over here in March, and then they were also taking profits over here in January. And the great thing about it is there's always a narrative, right, for what's going on. But the beauty of Bitcoin is that a lot of this stuff is on chain. You can see what people are doing, and if you want to sort of follow suit, you can. You can ignore it. You can look at it. But I like to have these charts there. And then one of the charts that I've created this cycle, well, me and my team, is actually the social risk, the social metrics, because this stuff is actually, so the social risk is created by looking at YouTube subscribers to crypto YouTube channels, views to those channels, followers to various crypto Twitter analysts or X on X, exchanges and layer ones. And you can see that the social risk has basically just been trending down since May of 2021, and it never really started going up again. My philosophy is that it's due to monetary policy, because back over here in last cycle, it did not start going up until we really had a lot of rate cuts and we had quantitative easing. That has remained elusive this cycle, which I think is one of the reasons why people truly never came back. I also think people never came back in any sustained way, because when they do, they were just shilled meme coins all the time, which has been sort of a cancer to the space, I think. And I think we're finally starting to slowly move past that. But this is basically what I use. And just to give you an idea of one of the metrics to go into, say, the social risk, if we go to the charts over here, we can scroll all the way down and we can just click on, if I can find it, it's pretty far down. I'll just search for it right click. So YouTube views. So if you look at YouTube views, we'll pull up a lot of different crypto YouTube channels, and you can basically see that YouTube views never really went to the same heights that they went to back in 2021. So those are probably the main charts that I look at. Occasionally I'll look at others, but those are the main ones I look at.
You also have the dynamic DCA chart. You're only buying at those very low risk levels.
Right.
So people don't realize that you're not actually actively buying.
As long as the risk levels allow for it, then I buy. And sometimes we can go months without them allowing for it. Sometimes it can be years. Sometimes, it can be, in a few days, right? It's hard to know exactly the timing of that stuff. But the great part is like, it's not if it happens, it's just when it happens, take action, right? No one knows when that stuff's going to happen. The markets get a little crazier in post-halving years, as we saw in 2021 and 2017 and 2013. If you're new, right, and you don't have exposure, and you're like, well, the risk is a little high. What I've sort of said before, and I will continue to say, is that you can always, like your first cycle, you can always DCA up to a higher risk level than you would otherwise be comfortable with in future cycles, but just because you want to get some exposure, right? So, for instance, let's say you want to DCA up to 0.6 risk this cycle, but it's just because you're joining, and then in future cycles, you'll only DCA up to 0.5 or 0.4. That's what I basically said in 2021. Now, in the short term, a lot of times it works out for a little while. Usually, especially by the time you get to the midterm year, historically we get bear markets. The markets go down. As long as you're willing to hold through that and not panic sell, then it tends to work out, right? If we think about what happened in 2021, when a lot of people were asking that question, was back when Bitcoin was like 30, 40K. It went back up near 70K, and then it sold off to 15K. But now, it went all the way up to $109,000. So a lot of it depends on your time frame. I would say one of the charts we have on here is modern portfolio theory. So this is like classical portfolio theory that you can use to figure out like what portfolio combinations you actually want to have in your portfolio. And the beauty of it, of looking at it like this, is that, a lot of people will share their portfolio and say, well, this is what I think is right. And then someone will criticize them. But I think what a lot of people don't realize is that everyone's wanting to take on different amounts of risk. So for instance, if you wanted a portfolio consisting of, say, Bitcoin, Ethereum, and US dollars to, say, buy the dip, right? You would want to know what portfolio, based on historical returns, maximizes your Sharpe ratio and or your Sortino ratio. And when you do that, right, you can see that, in this case, the portfolio that maximizes your Sortino ratio is 58% Bitcoin, 12% ETH, and 30% US dollars. Now, for a long time, the ETH percentage has been dropping. I've been anticipating it was going to drop. So one of the things you can also do is, instead of using historical returns as your expected return, you can, come up with your own alpha to figure out what do you think the future returns are going to be. And so because I was very, I didn't really have the best outlook on Ethereum back in early 2022, I basically just stuck with Bitcoin. I only really started looking at Ethereum within the last few months because I always thought it was going to at least go to the 0.03 to 0.04 level against Bitcoin. Now it's actually gone below 0.03. So it's actually gone below what I thought was a realistic target back in 2022. It took 2.5 years for it to play out, but I think this stuff is really useful. And so what you can do is, you can just find a portfolio somewhere on the risk curve. And, the further down you go, the more Bitcoin percentage it would be, or US dollars, right? If you really don't want to take on any risk. And then the higher up you go, it might lead to more Ethereum. Not because Ethereum always outperforms Bitcoin, but whenever it does move against Bitcoin, it can move very aggressively.
Okay, so someone's just getting into crypto now. They would maybe use the modern portfolio theory to set the ground rules or like the blueprint for their hypothetical portfolio. And then they'll get a percentage based on how comfortable they are with volatility in the market. So that would either be the Sharpe ratio or Sortino. And then they might use the risk chart and the dynamic DCA chart to figure out how they're going to start to diversify into that specific portfolio.
Right. And what you don't want to do though, there are some altcoins that might be at a low risk level, but if they only ever bleed against Bitcoin, we just call them bleeders. And, you really don't want to buy those a lot because they're probably just going to lose value to Bitcoin. And the great thing about this tool is that it can showcase that for you. So if I just remove US dollars and let's say add Litecoin, okay? So a lot of people, Litecoin's been around for a long time. A lot of people know what it is. But what you'll notice is that if you want to maximize your risk-adjusted returns, it actually says 0% Litecoin, right? And a lot of people get offended, right, at that. And this is true for a lot of cryptocurrencies. It will suggest 0%. So a lot of people get offended. But the reality is there's a reason for that. It goes back to opportunity cost, right? So we have another chart called Does It Bleed? And what you can do is you can go over here and you can pick out, say, Litecoin in this situation. I can't even, it's right here. And we'll change the standard to Bitcoin, or it's already on Bitcoin. And you'll see that the valuation of Litecoin against Bitcoin just goes down, right? I mean, occasionally it gets a spike up, but it more or less goes down. And so you can see over the last year, it's down 16%. Over the last 2 years, 67, 3, 61, 4 years, 66, 5 years, 81, 6 years, 92. And you get the idea, right? So since it's been around, Litecoin has dropped over 96% against Bitcoin. And a lot of people keep waiting for the trend to change, right? They think that it will change. And every post-halving year, at some point, you see like a rally, and then people think it's going to change. But ultimately, it just keeps on dropping. And so what you don't want to do is you don't want to go to a portfolio. You don't want to construct a portfolio in this case with, generally speaking, with an asset like Litecoin. I know it offends people, but what you don't want to do is you don't want to look at the efficient frontier up here and ignore it, because the efficient frontier basically shows you that to have a portfolio that maximizes your risk-adjusted returns for a given volatility level, you don't want Litecoin. But if you go down to, say, the red line, which I like to call the inefficient frontier, although it's not technically called that, you can see it would call for a larger percentage of Litecoin. But the reason why that's an issue is because your expected return, you have a lower expected return, but you're getting the same amount of volatility, right? So you're taking on the same amount of risk as someone who's way up here with more Bitcoin, but your expected return is so much lower. And because and we saw that with the valuation of Litecoin against Bitcoin, right? It's a macro bleeder. And so sometimes like the risk of the USD valuation might be low, but if it's just bleeding against Bitcoin forever, there's no point in really holding it long term. That doesn't mean that some people can't do short-term trades, but I'm not really known for taking a lot of short-term trades, right? That's not the purpose of Into the Cryptoverse.
You are definitely more careful and conservative, and that's partly why you're not allowing us to release the ETH shirt for a while. This is the new shirt that we are finally releasing. I'm Ben CMO, so it's sufficiently wrecked. We are releasing it, right?
Correct.
Because Ben doesn't know when ETH is officially bottomed. So he's trying to time the bottom here, and this is what he tells us not to do.
Correct.
Another rule that you say is we should avoid altcoins that are not double bottoming.
Right.
Ethereum's not really an altcoin. It kind of is. It's like the queen of altcoins.
Yeah, I like to think of it as like the index for the altcoin market. So, like if you own a lot of altcoins and they're underperforming Ethereum, you're doing something wrong. Now, this last couple of years, Ethereum has been underperforming.
It's not been doing well.
Yeah, it hasn't. It hasn't. And I'm really glad I was on the right side of the trade. And I only recently even got interested in it. And the reason I really didn't want to release this shirt for so long was because I created the shirt probably somewhere over here. And I kept waiting for sort of Ethereum to quote unquote go home.
Yeah,
Right?
I know.
To the lower logarithmic regression trend line, which is where it normally goes. If you remember the chart earlier, the ADI, the Advanced Decline Index, it started going up last cycle after Ethereum went to the lower logarithmic regression trend line. And I kept thinking, like, all right, this has to happen. Like, it has to happen at some point. I didn't know in 2022 and 2023 that it would take until 2025 for it to finally break down. But that's how long it took. And so what I've learned, right, I mean, it's really difficult to time exactly when these things are going to break down. But the process was, I think, I would argue that the process was always going to play out. That's the way I've always seen the cycle work. Like Ethereum, it can try to stay above it for a while, but eventually it does go to the lower logarithmic regression trend line after a while. And then it's usually from that point that it gets stronger rallies. And so the reason I didn't want to release the shirt in 2023 and 2024 was because I didn't really consider Ethereum to be sufficiently wrecked, right? I was looking at, some of these other charts, like the ETH Bitcoin ratio. Back in 2022, the ETH Bitcoin ratio was 0.08. And I thought it was going to go to 0.03 to 0.04. So it felt insincere to say that it was sufficiently wrecked at 0.08 when I thought it was going to, drop at least 50% on its Bitcoin pair. Now it's dropped even more than that. And I do think the Bitcoin valuation could bottom out at some point, but the thing that made it bottom last cycle was the end of quantitative tightening, and that still hasn't actually happened yet. So, hopefully it happens at some point, and hopefully we get a double bottom on the ETH Bitcoin pair. But that's the reason ultimately why I didn't want to release the shirt for so long, is because it didn't really feel like we deserved it.
Nobody likes to talk about this in crypto, but what about commodities, gold, other stocks? Obviously, tech stocks are a little bit scary if, the big R word, recession,
Right.
if we're dealing with a recession. But which charts are you looking at for diversifying into those other asset classes?
Yeah, I mean, for gold, we have a risk metric for that as well. But I mean, to be completely honest, for something like gold, I've been pretty bullish on it for the last couple of years. Normally, it does pretty well under the current macro conditions. If you do get a recession, absolutely gold would sell off just like risk assets would, but it would also very likely recover a lot sooner. And so I do think that gold has a place in a portfolio. My long-term thinking, and I've sort of operated under this assumption for not quite a decade, but maybe getting close to a decade soonish, is that I used to say gold, precious metals, commodities should be like somewhere between like 5 to 7% of a portfolio. And the reason for that is over the macro scale, risk assets outperform gold, right? Over a long enough period of time, going back, decades and decades and decades, the S&P 500 does tend to outperform gold. But there are certain times in the cycle where gold outperforms risk assets. And this year, gold has already outperformed a lot of risk assets, right? A lot of risk assets are actually down this year so far. Gold's up. So I remain bullish on gold. My long-term thinking for the last few years was that it was a good buy below 3,000. It just crossed 3,000. A lot of people also ask about silver and other metals. But I kind of think of it in the same way that I think of like cryptocurrencies. Until a lot of changes occur with monetary policy, you're likely going to see gold outperform other metals like silver, and palladium and copper, right? There's a good chance that gold is a better play, especially when you look at risk-adjusted returns than these other precious metals, until the Fed actually has a sufficient pivot. I think a lot of people were hopeful that, cutting 100 basis points would lead to alt season, and slowing QT would lead to alt season. But last cycle, it was really a lot of rate cuts. It was after the last rate cut of that business cycle, and it was after QE began. That's when all the alt season stuff started. So it's tough because a lot of people want to time everything with altcoins and and whatnot. But a lot of the processes, just have to play out. But yeah, gold has done really, really well. I think it will continue to do well for a few more years. Generally, when it goes on a bull run, it lasts for like a decade or something. And I think that it should do pretty well I think it will do it well throughout the rest of this year. My base case is that it will do well for the rest of the decade. But I think, you might have 1 year in there, maybe 2026, where it doesn't do so well.
So can we go back to the risk chart again?
Yeah.
Gold you look at for risk, you look at the risk chart for some of these other things too, or not as much?
Yeah, and we're working on developing other risk metrics right now. Like if we go look at stocks, like we have a risk metric for Tesla. We're working on developing them for like Apple, Amazon, Netflix, Microsoft, Alphabet, and Meta. We also have it for we have it for some of it for the indices like the dollar, the S&P 500. But generally for these things, like I don't operate under the same principles as I do with crypto. And the reason is because like crypto and especially altcoins are notorious for dropping like 98% or 97% in bear markets. The S&P doesn't drop 97%, right? Like that's not really a thing that happens.
Yeah, not yet.
And hopefully this is not the point where the narrator says like and then it dropped 97%. But with the S&P, I generally buy it as long as it's below 0.7 risk. Mm-hmm. Last cycle, I used to say below 0.75, but I feel like as cycles go on, I become more risk averse. But I think below 0.7, 0.75 risk for the S&P generally works out over a long enough period of time. There can be years where the market drops 20% or 30%, right? I mean, you have to be okay with that. There are occasionally really bad recessions where it drops 50%, but over a long enough period of time, the S&P 500 goes up, and if you decide not to buy it, if it's below 0.5 risk, then you're going to spend most of your life not buying it because the S&P 500 is usually above 0.5 risk because it's generally putting in new all-time highs. It's just designed, generally it goes up because they print more money, and that's the way it works. So for a lot of these, I don't really treat them the same way as crypto. I think with crypto, because it's further up the risk curve, I DCA it at lower risk levels because I know, like, if you're in crypto, you're already taking on a lot more risk than buying index funds, right?
Yeah.
You're already taking on a lot more risk because, I mean, there's a track record with index funds that they will eventually come back. With a lot of altcoins, what we actually see is that a lot of them come and go. Like, they'll be around for 1 or 2 cycles, and then in a future cycle, let's say if one day Bitcoin is at 300K, there's a really good chance that whenever Bitcoin does hit 300K, that whatever cycle that occurs, there's a really good chance that a lot of the altcoins in the top 10 are going to look very different than the altcoins in the top 10 today. So you have to be a lot more careful with cryptocurrencies. And I think one of the reasons is because with stocks, oftentimes they have more obviously proven business models. Like you can see how they're making money, right? Like it's easy to buy, for someone like me, I like to buy the stocks that I also find value in. So like I like Apple products, right? So I'm often buying like MacBook Pro or, whatever. I understand how they're going to make money, right? If you tell me an altcoin, like it's not always entirely clear like what the business model is, right? A lot of times people just say, well, they have a great community.
It's the roadmap.
Right. Yeah, it's the roadmap. It's like the promise of future returns, but a lot of times those promises are not really kept. And so that's the reason why I think you have to be a little more careful with cryptocurrency than other asset classes. But with that said, because the cryptoverse can occasionally sell off 97-98%, it does leave room for a lot of upside if you can stick around through those times.
How often are you buying something then? Because you don't really make decisions based on the news.
No, I usually just stick to the risk levels. Like I don't want to say never, right? Like there have been a couple of times in the past where maybe I made decisions, but I based on that kind of stuff. But what I've found most of the time as I've gotten older is that whenever I make decisions based on that stuff, it usually doesn't work out the way I think.
Yeah, that's true.
Right. So it's better to stick to other things. I provide my opinion about things because that's what people want to know, like what way the wind's going to blow tomorrow, right? So like I'll provide an opinion about it, but I'm not always like selling something just because I think it's going to go down. Because like for instance, if if I know for a fact that something's going to drop 5% and then go up 100%, I'm not going to sell it just so that I can buy it back 5% lower, right? Because you're going to incur capital gains and stuff. Like it's going to hit your bottom line. So even if you think the market could go down, that doesn't mean that you necessarily want to go sell, because first of all, you could be wrong, right? Like you could be wrong. And second of all, I mean, markets generally go up. So if you do get in the habit of, of selling a lot, then more times than not, you're going to be on the wrong side of the market. So I would say I'm generally buying something about every month, right? Mm-hmm. About every month. It's not always crypto. It's not always precious metals. It's not always stocks. I mean, it depends on what the risk levels are, right? So like if the risk metal, or if the risk levels for precious metals are high, then I might not buy those that month. And if they're low for Bitcoin, then maybe that month I would buy Bitcoin. But if another month, if Bitcoin is at like 0.9 risk, right, I'd rather sell that and then go buy something that's at a lower risk level.
Yeah.
Right? So it's more so about trying to get out of the markets when they're extremely high risk and getting into the markets that are low risk. But it has to be a nuanced approach, because there's a lot of technical analysis that I really don't agree with, because a lot of it just doesn't work. But one thing that does work is momentum, right? So assets that are trending higher are more likely to trend higher than assets that are not. So a lot of people make the mistake in the cryptoverse of selling an altcoin that's doing well for an altcoin that's not, because they think, oh, well, this one's going to pump next. And so what ends up happening is they sell the one that they sold their winner and they bought the loser, right? Mm-hmm. So you have to be careful about, just selling everything in an asset class just because it's a high risk level. But that's why I do dynamic DCA, right? Like I don't sell everything. I just slowly scale out as it gets more and more parabolic. And then like in 2021, when Bitcoin hit 0.94 risk, I mean, I felt like an idiot, honestly, at first, because I sold a lot of my Bitcoin, and Bitcoin was around 60K back then. And everyone was screaming for it to go to 300K. And it can really be hard at times, like not to believe it sometimes, like everyone's calling for it. The narratives are everywhere, right? Institutions are coming. They're not going to let this stuff happen. Yeah. But, you look back and you're like, well, no, it topped out at around 0.94, 0.95 risk. And just because everyone's calling for it to go that high doesn't mean it's going to. Just like when January 20th, right? When the inauguration, a lot of people were really bullish back then. And instead, the markets have dropped ever since. And I think it was just because the markets were pricing in perfection, right? I think the markets were pricing in a strategic reserve, deregulation, Gary Gensler resigning, and, it hasn't really turned out the way they thought, right? We got meme coins being launched by presidents, right? Mm-hmm. We got, a strategic reserve, but they're not buying Bitcoin yet. That doesn't mean they won't, but they're not doing it yet. And so you have to be careful with the narratives, because they can seem very convincing until, you fast forward a few months and you're like, oh, maybe not.
Narratives with crypto feel very different than, say, people who will listen in on meetings of these really big companies in order to figure out where they think that the stock is going for the next 2 months or so.
I think I usually, most of the time, I would say 90% of the time, I just stick to low expense ratio index funds. I don't even try to get too fancy with stock picking. But when I do pick stocks, it's usually because I find value in the products that company makes. So I just naturally look at it because I'm interested in that company. Like Apple, right? I'm interested in that company because I use their products. And I assume that if I'm using their products, then other people are also going to use their products. And if I find value in it, then other people will too. And I think it'll be around in future years. And so there's a good chance it'll eventually go up, right? So I tend to, if there's a product that I use, like Amazon, for example.
I don't know why you're pointing at me.
If you're trying to order a lot of stuff to make an office look nice, then, you could assume that all right, well, if I use this, a lot of other people use it, and therefore they have a good business model, and, therefore it'll be around in a few years. And so maybe it'll outperform the stock market. Even Tesla. I mean, Tesla got hit really hard recently in terms of the news,
Yeah.
Really, really bad news coming out for that sort of the Tesla side of things. But I don't actually, have one, but I do think that Tesla is a good company, and I think they're going through a rough patch. And I remember looking at the chart for Tesla back in 2022, and I first got bullish on Tesla in 2013 when I was in grad school, and I spent a long time like watching the stock go sideways. And I remember like watching it go up once and put in a new all-time high, kind of like it just did, kind of like it just did. And then after it did that, back in, way back in, sort of like halfway through the 2010 to 2020 timeframe, it then came back down in 2018, 2019. And I remember like wondering like, well, it needed an extra 2 to 3 years of consolidation before it was really able to move to a much higher level that we saw in 2021. And so I kept thinking like that's probably going to happen this cycle too, like where people are going to think like, oh, it's going to go to an all-time high, and it did. And they're going to think it's just going to keep going up forever, but it's probably going to sell off, and it's probably going to consolidate for another year or two. And I didn't know what the narrative was going to be that people were going to assign to it, but of course, there is one now. But it's actually doing something very similar that it did last cycle. And my guess is that it's probably going to take another 2 to 3 years before it really can get moving again. But yeah, it's easy to assign narratives to stuff. But I am under the assumption that narratives follow price action, and price action does not follow narratives. That's why I don't put a lot of validity into narratives, because a lot of times, I mean, if you see a narrative, it's already priced into the market, right? People that knew that narrative was going to happen before you did, they already bought or sold based on that. And if you're buying it, they're selling you their bags, right? So by the time you know about it, I mean, on Wall Street, right? If you go to Wall Street and you like do research into like these big banks and these big like trading firms, they have connections like underground of this building to just get the fastest connection speed they can to the markets, because it literally, like, that is the difference between a successful trade and a millisecond sometimes can be the difference. So if people on Wall Street are fighting for millisecond differences, you have to think that like retail traders that are going based on the news headlines are probably not getting really any alpha by reading the news headlines.
I was talking to somebody who was a Harvard professor saying how people in Wall Street, they're starting to use AI to improve those milliseconds to be even faster.
Yeah.
When buying corn or whatever, the news on your TV is one thing, but then news in crypto is times 1,000.
Exactly. Yeah. You really can't believe everything that you hear.
What do you do for fun?
Do for fun?
Yeah.
I play some sports. Sometimes I play like racquetball, pickleball, disc golf, sometimes tennis, but not as much recently. I like playing soccer with my kids, and baseball and basketball. So I do a lot of that. I play chess. I usually play chess almost every day.
Oh, you do? Who do you play chess with?
Online.
With who? Against who?
Random people.
Yeah.
Like a lot of times in the morning, I'll play before I like start working, because I feel like it gets the brain going. Or sometimes I'll play with like like one of my kids.
But I thought you played more during the bear market. I didn't know that you played every day still.
Yeah, I usually play. Because even in whether it's good times or bad times, you gotta play chess. Chess is more important. My wife and I will like travel to some cool places. We'll take the kids. I watch a lot of sports too.
Yeah.
Yes. I watched a lot of March Madness.
I didn't realize how much sports that you watch. I kind of think of you as like this very practical person. I remember when the first party that we threw for Into the Cryptoverse, for the Into the Cryptoverse premium subscribers, I think you gave me 2 weeks to plan this, and you're like, hey, let's do some sort of meetup. And it turned into a huge party. It turned into a big party on a pet house, and you were happy to do it because you really do care about the people. You really do care about your subscribers and your family. But when it comes to you, we were going to some event and you took out your wallet. This is what it looks like. This, just so you know, Benjamin Cowen is. This is Ben's wallet.
Calm. There's literally like.
This is a wallet.
My comb, not that I need one right now, but like when my hair grows a little bit more, like my comb, all like the bristles in between are gone, and there's just like 2 or 3 on the end.
I don't even know what to say about that. Ben said that the only thing that was wrong with this wallet is that sometimes the cards would fall out here, but otherwise, like, there's no problem with it.
Yeah.
So this is the stuff that my dad used to do. He would just never replace anything, but take care of his family. So anyway, I think that you're very successful because you know what matters and you're happy spending there. But this is what we're dealing with.
Yeah, but I mean, like the background of my videos for like years was just like whatever happened to be back there. Um, but I think it does look good. I mean, I know you did those, and it looks a lot better.
I don't know why you keep saying that. You don't have to be embarrassed about it.
I don't have the creative vision to do any of this stuff.
Your desk was just this cardboard box, and you had
Hmm.
a piece of glass, like a
On top
glass
of it,
sheet on top of it.
yeah, I had that desk for like 3 years, and it was because we moved, basically across country, and the desk that I was using broke in the process. And I didn't really want to go be bothered. I couldn't be bothered to buy a new one. So I just took three of the packing boxes that we had moved with, and I just set those up like 1, 2, and 3, like in the shape of an L, and just put two slabs on top of those. And that worked for a long time. But then I was really sad one day because I had to get rid of it. But the reason I had to get rid of it was a good reason to get rid of it. I opened one of the boxes up because we needed something from inside one of them, and I opened it up, and I realized it was infested with spiders and bugs and stuff. Um, and so yeah, I had to get rid of it because I didn't want to like be working with like bugs. I recycled my desk.
When did you end up getting a real desk?
I want to say it was, I don't know, sometime near the end, maybe like the third quarter of 2024, maybe, something like that. Just so it was more stable and not something that I had to like, get out and put back, or, we might need it for something else. So I finally did get a real desk. So unfortunately, we're past the cardboard desk phase, but uh,
So if the spiders didn't move in, then would you still be dealing with the cardboard desk right now?
there's a good chance because I really am of the opinion if it's not broke, don't fix it.
What's something that you changed your mind about after launching Into the Cryptoverse?
I don't know if this is before launching. I can probably come up with several examples, but the first thing that comes to mind was I'd rather be rich and wrong than poor and right. Um, that was the first thing I realized way back when, like that being right isn't everything. And this cycle, especially, being right isn't everything. You do need to, like, the path is important as well. Um, I am pretty stubborn about my views sometimes, and sometimes it works out amazingly well, and other times it haunts me. So maybe I've learned that it's better to pivot a view sooner rather than like hold on to it for a really long period of time. Um, Only to then like have to later admit I was wrong. Right? It's better to pivot sooner, as soon as possible, than to pivot too late. So that's probably something. Um, I also think too, I mean, when I first launched into the cryptoverse, I was already thinking of my portfolio in terms of Satoshis, but I also think that every cycle that goes by, I truly believe like every cycle that goes by, everyone sort of becomes a little bit more of a Bitcoin maxi. Um, Especially this cycle. This cycle, I think, has taken a toll on a lot of people. And like the Bitcoin dominance uptrends lasted a long time, but I think that's something that sort of changes it with everyone, from one cycle to another. Um, those are like the main things I can think of at the time.
What do you think is one of the behind the scenes part of running your channel that takes a lot of energy that people don't really see? Other than the fact, caveat, other than the fact that probably what percentage of your audience do you think doesn't even realize that Into the Cryptoverse is a website?
Yeah, there's a lot of people that don't. When I go to conferences, a lot of people don't realize that we have anything like that. So, I mean, that'll probably take them a majority of my time because the YouTube videos actually take up really little time because I'll be working on something random. Maybe I'm like, trying to figure out something with the website, or I'm talking to some of the developers because we actually have, maybe people don't know this, but we have a developer team, and they're basically recreating a lot of stuff that I had created back in 2019 through 2021 just on my own. They're also adding a lot of new stuff. So I mean, the website would be, it would be nothing without them. The biggest time is probably sort of focusing on the development of the website and figuring out what new features we're going to add, and implementing those, finding bugs, and then figuring out how we're going to fix those bugs, because bugs happen all the time. Finding new data sources. We're always looking to expand. We expanded beyond crypto. And when you expand to stocks and macro and commodities, you have to find data sources. So, I mean, that takes up a lot of time. The YouTube videos take up actually about the lowest amount of time for a lot of it, because it's just, I usually just record it in one take. So if you see a 30-minute video, I just took 30 minutes to make it. If it's a 10-minute video, it took 10 minutes. If it's a 2-hour video, it took 2 hours. So there's not really any behind the scenes there with the YouTube videos. I don't practice ahead of time. I don't, figure out exactly what I'm going to say. It's more just going through it it's like stream of consciousness almost, which is why I end up repeating myself a lot, which is probably why I'm probably repeating myself now. But yeah, I would say probably the website is probably the biggest time thing, and just figuring out how to make that better and provide more charts and other tools that people can use.
You really do just sit down and then decide.
Right.
And record.
Yeah, I'll go watch. Yeah, I'll go watch a March Madness game.
Right.
And then come in here, record a video, and go watch the end of it.
I mean, yeah, that's really what you do. I asked ChatGPT to ask you a question, and this is what they said. They said, when dominance rises, do you feel vindicated, or do you just quietly whisper, "I told you so" to your portfolio?
Well, I think at this point, I think the hard part was waiting for 60%, because that was what I thought was a realistic target. At this point, I think a lot of people have kind of already accepted the whole Bitcoin dominance narrative. So it doesn't really feel it feels like if it just keeps going higher, I don't really gain anything else from that at this point, just because it seems like the narrative has become more obvious to people, right? So it's hard to say exactly how far into the trend we are. I mean, I think we're pretty far into it, but yeah, so I wouldn't say it used to be more of an "I told you so" up until we hit 60%. Now I think everyone's just waiting for, all right, how high is it actually going to go before it turns around?
I just think that's funny that that's what ChatGPT said. That was the first question that it came up with.
Yeah. Well, because it was difficult, because in 2018 and the first half of 2019, Bitcoin dominance went up, and it basically peaked in the pre-halving year. So a lot of people would have assumed that it would have done the same thing this cycle. And I think a lot of people sort of dismissed monetary policy just because they wanted alt season to occur. But there really was no great reason to expect alt season so far this cycle, at least not until monetary policy sufficiently changes. So
as we know, I'm Ben's CMO, and he doesn't let me do any product placement or anything like that. But we did come to an agreement that if Cheerwine wants to sponsor Into the Cryptoverse, that you would agree to that.
This might be true.
I see one on your desk, right? Yes. I mean, there is one on your desk all the time, and I actually kind of like it. And it doesn't taste like cherry Coke at all.
It's true.
Yeah, so if they want to sponsor Into the Cryptoverse or the party coming up, then that is the one sponsorship.
Then reach out to Dana.
Yeah, that's the one that you're willing to do.
I do like Cheerwine. What can I say?
The party is coming up for the premium members, and that you do every year, and that will be throwing in Vegas. So I'm looking forward to that. And also, Michael Saylor at his party did tell me to send him an invite. So I look forward to seeing you there, Michael.
Yeah, if he comes.
And I'll also put all of your links in the video, and with all of my subscribers are watching, because there's so many. Thanks for coming on.
And if you're one of my subscribers watching, you should subscribe to this podcast, the Explain Yourself podcast, because Dana's doing a lot of great things on her own channel too.
Thank you. Thank you, Ben.
Thanks for having me.
See you guys into the Cryptoverse.
If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.